I'm now pleased to introduce our next presenter, Mitch Barnard of Wildpack Beverage. The ticker is appropriately CANS, C-A-N-S, on the Venture Exchange. Wildpack is a co-packer focused on can filling, can decorating, as well as can brokering in the U.S. The company went public just a few weeks ago and is already showcasing tremendous growth, having finished 2020 with $12 million in sales. And they just reported a few days ago their Q1 2021 numbers, and they're already running at $25 million in annualized sales. With that, Mitch, pleased to have you with us. Over to
Thanks.
you.
Yeah, perfect. I appreciate the kind introduction. And I look forward to the presentation and the questions at the end. So we'll just skip through the boring stuff into what we are. So Wildpack in a nutshell, it's a very simple story. We're a middle market beverage manufacturer, and our focus is really on serving brands that are everything from a startup all the way up to just the step before Coca-Cola and Pepsi. And we're really focused on filling a major market void with respect to capacity, and also building our business model around the actual needs of our customers. And so what we do is very straightforward. We fill, decorate, and broker aluminum cans. We're aluminum can centric. And what that really means to our customers is we do about 70% of the things that a brand needs to take their beverage idea from an idea to on the shelf. So we're kind of the quarterback that sits back as part of their supply chain and make sure that everything runs. We currently operate 3 facilities. The first 2 in Baltimore and Sacramento. They were both acquisitions. And we recently built, as reported in Q1, the Las Vegas facility. And our goal is to build a network of facilities over the next 24 months, such that we achieve appropriate saturation to limit shipping costs of finished goods and raw materials for our customers. And it entrenches a very strong strategic advantage for us and the people who decide to use us as their co-packing partner. So I won't belabor the capitalization. This is what we came out of the go public gate as. Our enterprise value now is hovering up in the 70 million range, a little bit higher than that at times. The only thing that I'll really talk about is two points on this. Number one, there's a lot of insider ownership in the company, and we heavily participated on the go public round. Obviously, all of that comes with traditional long-dated lockups, and we're a management team that's very, very focused on the future and the growth of the business. And the other thing that I'll say is, generally speaking, we're relatively unlevered compared to our growth rate and our assets. So we're currently sitting just under 5 million Canadian. That might change, slightly in the near term, obviously with what we announced today, but I won't go into too much detail on that. But the company has a very, very strong balance sheet and a very, very strong capitalization. From a management perspective, what you will see and what we've done now and what we're going to continue to do is you're going to see really 2 leadership teams being built. The first leadership team is the growth leadership team, and it's really the 4 founders, the first names on this list. And we are really focused on how we're going to go out and build and buy things to grow into our market opportunity. So, it's ex-securities lawyers, ex-M&A lawyers, ex-public accountants and CFAs, and Steve's a historic serial entrepreneur in the consolidation space. So really we're built to go out and buy and build things to be able to grow into this opportunity. And then what you'll see is a consistent trend of us adding depth at the operational level behind the growers, call them. So Chuck Zadlow, we recently announced his involvement in the business, and we brought him in as the COO and moved Tommy to the Chief Growth Officer. And he has a perfect background for what our business is. He was a Coca-Cola turnaround specialist for their beverage plants, walking into underperforming plants, re-optimizing them and integrating them back into the system. He then moved to be the COO of Revolution Brewing, which is one of the biggest breweries in the US. And with a massive amount of analogous features to what we're doing. So he's really building that team up behind him, but you're going to see this trend as we continue to grow. 2 real teams, one focused on growth excellence and one focused on operational excellence. The board of directors, exactly the same strategy. So we have a lot of depth in Sage. We know we're a bunch of young bucks out here running around growing this thing. And we want to tamper that with a lot of Sage and wisdom with the capital markets and large businesses. So you'll see a good chunk of our board is really focused on 20 plus years in the markets, 20 plus years, and leadership positions both as directors and officers of companies ranging from 100 million to a couple $1 billion market caps. And then you see that countersink of growth focused individuals. We have everything from ex-KKR private equity folks who really focus their entire kind of careers on consolidation roll-up strategies, as well as entrepreneurs who have used the capital markets to continue to grow and again use those consolidation strategies. So we're really building out two distinct teams within the Wildpack leadership that will work together to affect not only the growth story, but also the operational excellence we need to drive things to the bottom line and create the returns that we're looking to create on assets. So we always kind of go into a high level overview of the really important things in the presentation so that as I hit each slide and every trend, you can see how it plays into the bigger picture. So, to paint a very broad picture that we'll drill into in a little bit, demand for middle market beverage manufacturing services are, the highest that they've ever been, and they continue to soar. And, that was happening pre-COVID, and COVID really accelerated it. And coming out of COVID, we're seeing a continued kind of alteration in the way that humans consume beverages. And there's much more demand in the RTD space because most people don't want to go and, even though things are reopening, go back and drink out of a glass that a bunch of other people have used. So RTD is growing at a ridiculous rate. Most of that growth is happening in the middle market with a bunch of new brands in the craft consumption ideology, and there's just not a lot of capacity available. Most of our competitors are single facility, single service owner operator businesses that can't really scale. So we're really stepping into the perfect landscape for a consolidation. And obviously being in the capital markets allows us access to capital we need to grow and take over the market demand. As far as how we alter the assets after we either acquire them or build them, it's a light CapEx brush because the facilities we're building are running at a lot slower speeds than the Coke and Pepsis or Refrescos of the world. So we can step in, remove throughput roadblocks at a relatively cheap rate, which increases our return on capital and allows us to generate the returns that we're looking for on a facility by facility basis. The last thing that I'll say is, we're in a very archaic industry. It's a lot of, most folks kind of in the 30s aren't really focusing on building beverage manufacturing businesses like we are. They're off looking at cryptocurrency or DeFi. So there's no true succession plan. And right now, the way the industry operates is relatively archaic in the sense that, the normal ordering process is faxing POs and so on and so forth. So we're at the forefront of building a digitalized solution to be able to, solve that problem for our customers and make their supply chain look a lot more like a Domino's pizza tracker than an archaic, faxing back and forth situation, which is very important because if you look at the avatar of a traditional, a CEO of a new beverage brand, they're a 30-year-old something millennial, venture backed that grew up in the Amazon era. So it's something that they're looking for in a partner and something that we'll be at the forefront of providing. So we've been exceptionally busy as a management team, and you'll see that we continue to plan to be so long into this year and beyond. So we acquired 2 businesses in June of last year. We went public in March. We built our first facility ground up in April, and we obviously finalized the go public and listed in May. So it's been a very, very busy, all the while we doubled the revenue of the facility that we acquired for the same period comparatively before we acquired it, which I'll talk about in a moment. But since then, we publicly announced we've obviously brought in the COO. We've entered into 3 LOIs for new facilities, which we're working through. And you're going to see that path play out. And on the other side, you're going to see internally, we're adding new lines in our existing footprints through our staged upgrades to be able to increase capacity and throughput within our facilities to service more of our backlog of demand. There's a substantial backlog that continues to grow because there's so much demand and such a lack of capacity. The other big things on the horizon for us that we're talking about, we're not giving you a ton of guidance on the specific things that we're doing and what the economics of those look like, but we're going to be internalizing certain processes that are currently outsourced. And like I talked about, the plan is to get the digitized ordering process in place before the end of the year. So moving to the industry and the market dynamics that are really creating this mega opportunity for us. The first thing to talk about is the basis of our entire business, which is the aluminum can. So we went out kind of ahead of COVID, throwing the entire supply chain underwater far deeper than it ever has been in the history of its existence. We went out and signed significant contracts with international providers to service what we had modeled out our demand to be over this year. And at the time, that was a relatively faux pas thing to do in the United States. Most people wanted domestic can supply, which is very problematic for the middle market, because the way that the major can players operate is they sign contracts with the big players like Coke and Pepsi, Diageo and the like. And then they sign allocation arrangements with middle market players, which basically means that they can cancel their orders whenever they feel like it. So that doesn't work when you're solely dependent on the aluminum can. So obviously we went out and we found other avenues that got us to a very similar price point to as though we were buying domestic supply. We did the QA to make sure that everything worked with all of our customers. And we've been taking delivery under those contracts now for 5 months, no issues. We've had a very smooth supply chain, and most of our peers are currently underwater with no access to cans. Those contracts allow us to move into next year as well, which is a great advantage. And at that point, we'll be large enough that we'll probably be able to move into more contractual relationship with domestic suppliers to basically isolate our long-term advantage, which is the network. So we're really leveraging our near-term advantage of cans during a shortage now to build our network. And then once our network's in place, that'll be our long-term strategic advantage. So kind of already talked about this, but we're in the greatest can shortage in the history of the world, frankly. Traditionally what you would see in a non-COVID universe is throughout the winter, the domestic suppliers are really selling all of their cans at a 95 to 100% utilization basis. And then in the summer months, you see demand spike. They go underwater 10 or 15%. And then obviously in parallel to that, cut off the bottom 15% of their customers from allocations. And then you start to see a normalization occur following the summer. An equilibrium occur a few months after that, and then you have 2 or 3 months of everything's normal, and then people are ramping back up for summer. So middle market beverage manufacturers and middle market beverage brands start to get cut off in the summer months when they need access the most. When COVID hit, obviously we saw a massive acceleration in the consumption of RTDs for good reason. All of the tap rooms and bars were closed. And there was a lot of people theorizing what was going to happen on the other side of that. And what we've seen is that consumption ideology has changed. So when people are opting more for a single-use container situation, and when you layer that on the already growing RTD before COVID, the already growing move of new brands from other container types into aluminum, which we'll talk about in a moment, the supply chain just can't keep up, and the speed at which these facilities can turn on, the can manufacturing facilities, is slow. That when you model it, we're going to be underwater for a very long time. And Ball, Crown, Ardall, the big players in their most recent earnings calls are already talking about when they think normalization will occur well into 2023. But we have access again, which is one of our near-term advantages. So we briefly touched on this, so I won't highlight it too much, but the RTD space was growing ahead of COVID and is anticipated to continue to grow well after, obviously, with COVID being an accelerant in that, even after reopening as consumer consumption patterns have changed. The biggest thing for us is really the cross-section of where we do business is the place that's growing, and new brands are launching in aluminum containers for all kinds of reasons. It's cheaper to ship. And I think predominantly one of the main focuses is really ESG. And, we share that with our customers. We're inherently a very environmentally focused business because, we only operate in the aluminum can space, which is the most recyclable of all container types. So we have an inherent there. We also obviously are working towards ESG assurance level, things with respect to sustainability within our facilities with, electricity, water, because we are a large user of both. But on the demand side, if you look at our customers, it's very, very similar. Like look at Diageo or Coke and Pepsi or any of these big companies, and they're making commitments to ESG within the next 5 years that really can only be achieved if they're moving most of their product offerings into aluminum cans, which for us is, we're seeing that on the demand side, and the market's been seeing that for a while. And it's continuing through the reopening, which is obviously, a very strong thing for our business as well. The last thing that I'll touch on from a macro trend perspective, we've already spoken about the fragmented bottom in our competitors, but something else that's really driving demand for us is the big players in the co-packing space, like Refresco, are buying up the top end of the middle market, single facilities, increasing their line speed, and then really pushing out their smaller customers because they're on a let's run one SKU as long as possible and not change over model, whereas we're a much more flexible, co-packing partner that anticipates significant changeovers because that's the size of the customer that we're trying to work with. So what we see is a lot of very, very large customers from our perspective pushing down into our market because they can't find capacity at the top end because the minimum order quantities get pushed so large. So you're really just blowing up the exact cross section where we do business. Again, another major macro trend and why we're so hungry to go and build more capacity, more facilities, because even though we're sitting at a cross section where there's significant demand relative to capacity and our backlog continues to grow, we think that the macro trends are really blowing over the near to mid-term in that direction as well. So what are we going to do? And how are we going to take advantage? And the answer is we're going to build a lot of things. We're going to buy a lot of things with a slight lean towards buying, which we'll get into in a moment. So we're a consolidation strategy. That's what our business is. It's what we've talked about in all of our investment presentations, and it's what's disclosed within all of our public disclosures. But really, that can happen in two different ways. So we've done both now. So I can talk about what they look like to us. So the Sacramento and Baltimore acquisitions, the easiest way to think about it is that in the 6 months after we bought those companies compared to the 6 months prior, we doubled their revenue. And how you do that is you assess the weak points in the throughput of their manufacturing lines. You deploy some light capex, remove those, build some systems around how those facilities operate, give them a better back office, and things start to ramp off. So you can see it in this chart. In August is when we downed the facilities to make a lot of the changes. We did a little bit more in October, and then things start to escalate. And that's a trend that we look for when we're looking at acquisition targets, is when we're buying a company and valuing them based off specific EBITDA targets. It's, well, what can we do after? What does the next 12 months look like? What's the staged upgrades look like? What's the CapEx required? What's our return on capital? Does it make more sense than to buy things? In many circumstances, almost all that we're looking at right now, it does. Build things, I meant to say. We've also built, and our cost of building is quite cheap and modest at $2.3 million. And we can build those in about 5 months. So for us, the real way to look at, well, how are you going to grow, is we're going to be opportunistic within our geographic focused ideology. So we know we need to be in very specific geographic locations in the US, up to about 12 facilities, to hit the right saturation number to drive down shipping costs for our customers, which in turn provides a significant benefit to them and thereby a strategic advantage, competitive advantage for us as a partner. And so we need to be in those locations. So what we do is M&As we typically do a little bit better on a cost perspective. So we look for facilities that make a lot of sense. We do a deep due diligence. If they make sense, great, we'll move forward. If not, we'll build there. We publicly announced recently 3 LOIs that we're looking at. We have a very deep pipeline of potential opportunities. So that's really the approach that we're taking on how we will grow. So we're not giving any guidance on what we'll do this year. Obviously, we're growing at a rate that it would be relatively unprudent to do so. So just from an illustrative perspective on a 4-wall EBITDA basis, our facilities will generate strong EBITDA, and then obviously we do layer on overhead from an SG&A perspective on top of that. But on scale, things look very, very strong. And just to put it in perspective, we're currently burning through 10 million cans on between our two major segments being decorated and filling right now, which we released in our most recent MD&A. So these numbers aren't all that unreasonable, and the scale that we're talking about is not that far off. But if we're able to decorate 120 million cans, and if we're able to fill 4 million cases, we end up north of 12 million of EBITDA. So there's strong margins on this business on scale, and really we've built our our back office to be able to operate 6 facilities as we sit today, and as was reported in our Q1s and described in our MD&A and our press releases. So we're very excited for what the future might look like. As far as the acquisitions and what the kind of boiled down, simplified economics look like, our goal is to always buy things at a substantive discount to what the public markets are going to trade those cash flows at, or those financial metrics, I should say. We're often, because most of the companies we're looking at are very similar to us. They're full capacity, well through 2020, through 2021 and into 2022 already. We're obviously valuing most of them the same way that we're being valued, I believe, on multiples of 2021 revenue and EBITDA. We bought at very, very attractive multiples in Baltimore and Sacramento, but had to do a very aggressive overhaul. We're looking a little bit further up the chain now at companies that are positive EBITDA already, but still have a significant throughput ability if we make the right changes. And we're looking at buying those at around 6 times next 12 months EBITDA. The markets are trading those on an average basis far higher than that. As far as how we're breaking out the consideration on those transactions, we're always trying to weight equity and debt to get to strike a nice medium where we're incentivizing long-term growth of that facility and those owners with a payout so that people are happy and all the right incentives are in place. The interesting thing to note is most of the facilities that we're looking to acquire are either under-levered or not levered at all. They're owner-operator. They've all been pulling a strong salary, and most are afraid of leverage. So there's a lot of opportunity for us to use those cash flows to obtain additional leverage, which should chunk into that equity component. So you basically end up in a light leverage buyout basis on the cash side, which again is very attractive for us on a returns basis. Which makes the M&As a very attractive way for us to grow. Our team is built around it. Like I said earlier, we have M&A finance guys on staff that this is all that they think about. So this is a very good way for us to build our footprint, and obviously we've announced that we're undertaking it right now. I won't belabor this point because multiples are multiples, but we are still, as a very new story, trading below what the averages are. On a go-forward basis. Obviously, we're not giving a ton of guidance, so it makes some sense. But as we continue to, and I think that Amir laid it out, if you just quantify out what our most recent Q1s were and you assume no more growth, we're still trading at a relatively modest multiple. And when we continue to prove our story, prove our strategy, we think that things will trend in the right direction. So we're pretty optimistic about what the future has. So that's the end of the presentation. I'll pass it back off to Amir and open to any questions.
Thanks, Mitch. As a reminder, we encourage you guys to ask questions through the Zoom platform. I see we already have one, or you could email me as well. The question we have on the Zoom platform, Mitch, is what are the size of the cases for the slide 20 metrics? I think they're 24
yeah.
Ounce.
Yeah, 24 12-ounce case equivalents. Yeah, that's right.
Great. Okay, maybe I'll kick it off. Mitch, you spoke to a very constructive industry backdrop with the growth in RTDs, notably. Can you give us more color on the shortage of cans in North America? The growth in RTDs isn't anything new. Are there any other drivers that we should be thinking about? And with, I guess, COVID subsiding south of the borders, what are the early trends you're currently seeing?
Yeah, no, 100%. And I mean, so yeah, RTD's been growing for a very long time. It's nothing new. We see it everywhere. I think what's the real change that's been occurring is the speed at which brands are moving away from other container types and into the aluminum can. So you layer that on top of the acceleration that COVID did to the RTD space, generally speaking, and you take a supply chain that was on the edge at the best of times and put it 20 or 30% underwater. And then you layer on the time it takes for can manufacturers. So think about it, right? You have the growth that's already happening. You've now took the deep end and put it 20% deeper. And then you look and you layer on, well, how long does it take can makers to build new facilities? 2 years is really what 18 months to 2 years. How long does it take to just reach back to and crest meeting the normal growth? So I think that's really what's driving the can shortage, generally speaking. Obviously, COVID threw it for a loop. But as far as early trends go, we obviously operate our business as really an early indicator of what's happening in RTD because we're planning production for RTD brands for the next year, right? So we're looking, and they're making their plans based off consumption data. And we were all looking very eagerly, about 3 months out from when we thought reopening was going to happen. Well, what's going to happen? Are people going to go back to the bars and they're not going to drink single serve, and RTD is going to slow down? But we've actually seen an acceleration, which in our estimate is largely due to the fact that consumption's changed, and people are going to more likely choose a container versus a glass. And we think that'll continue, and we think equilibrium is in line with I think what the can makers are saying in their earnings calls and putting out in their MD&As. of 2023 kind of being the earliest that there's an equilibrium between supply and demand of the aluminum can, which again I'll say is largely, when you look at it historically, even in good years, in the summer months still underwater. So,
all right. I've got a couple by email that I'll try to consolidate. So what's the rationale of a decentralized network strategy relative to driving operating leverage through larger facilities? And the second question, which is sort of related, you spoke to shipping cost savings.
Yep.
Maybe you can give us more color on how much savings are there for your clients and how your pricing would be differentiated from competitors.
Right. So I'll actually start with, and I think the right place to start is at the end. So our pricing is market to the middle market. So to our competitors, people that are operating in the same space, the same run sizes we are. It's very premium to what Refresco is charging, running at 2,000 cans per minute. But again, they can't service these customers because the units of loss would be too large, because the speeds, the lines run too fast and they wouldn't shut them down, right? So we're on market with respect to our pricing in the middle market. But moving back to the beginning, why decentralized? Why a network versus a more centralized approach? And the answer is really in what you described, the economics for our actual customer. So if you look at their contribution margins on their beverages, and we had an interesting insight into this, is because we came from the consumer packaged goods space. Their gross margin will fluctuate between 10 and 15% if they have to ship across the country. So it's a significant impact to our customers relative to if they can get into one-day shipping. And one-day shipping is really a 300-mile radius from wherever the end distribution location is. So the way the beverage market typically works, generally speaking, there is some direct-to-retailer stuff, but the big players, you have the ingredients hit our co-packer. The co-packer does what we do. We put it in a can, we put it in a finished good. You have a pallet that's done. And then that gets shipped to a distributor. The distributor then ships it out to all the retailers. Those distributors, those DSs, are kind of scattered across the country in all major sectors. So we want facilities within all of those kind of major sectors within 300 miles. So we've specifically built out a model to determine where the right locations are. And we need about 12 to hit the right saturation. And then we can, give our customers who are paying the same rate as they would be paying at a centralized location, the added advantage on their contribution margin, to be able to ship less. And for us, that's great because it entrenches a longer term relationship. But obviously, the better they do, the better we do, and everybody's happy. So I think that generally answers your question.
Yep. We're just like one last one that I'll take from the platform. You guys have some sort of target internal IRR, or how do we think about return profile of building versus acquiring?
Yeah. So for us, we don't get into IRR per se, but we're typically looking at, when we buy facilities, what's the EBITDA that they're going to put off, and what's our time frame on returning the capital that we deploy, whether it's through buying the company and upgrading it, or buildings right out of the gate. And we're looking for sub 24-month return on an EBITDA basis is typically speaking what we're trying to see. Obviously, we prefer and have been, based on what we've been doing so far, things that are far better than that. But that's the general metric that our team's looking at. And there's a lot of different things that we're assessing when we're looking at acquiring companies. For example, some companies come with existing can relationships, right? Some companies come, tightly knit with a certain customer base. So we're really assessing, and those models are being refined based on the specific entity. But from a general perspective, we're looking to take companies that we can return our capital on an EBITDA basis within less than 24 months.
Great. Thank you, Mitch. We still have a few questions, but we won't be able to go through them. That was evidently a great presentation and intro to a new, an exciting public company.